Hi, Paul Drinkon with Prosperity Coaching Associates. Want to talk to you today about the topics really covered in our training sessions for clients and interested individuals this past Thursday. And that's really 3 signs that you might be speculating and gambling with your investments. The first sign is a thing called stock picking. Now, we all know that the way most people get into the market these days is through mutual funds. And inside those mutual funds, the managers of those accounts are constantly buying and selling stocks that they think are going to do well. They churn that account, if you will. Now, how does that really perform? How do they really perform, these professional managers? Well, academic and scientific studies show that over 85% of these professional managers cannot outperform or do not outperform a simple index fund. Now, let me define an index fund briefly. An index fund is just when an organization takes, like the S&P 500, the largest 500 companies in this country, and they buy them in proportion and just let the stock set and keep them in proportion and never actively buy and sell. 85% of your professional managers cannot outperform a simple index fund. That's number one. Number two, because of what happens is I have a lot of people tell me, well, Paul, I understand that a lot of these people underperform, but what I do is I look backwards. I look at the history, the performance of these managers going back 5, 10 years, 3 years, whatever it might be, and I pick the ones that have been successful historically with the funds. Well, again, academically and scientifically, when you evaluate that, almost invariably, if you look at the top performer in one of these time periods, and then you project how they did in the next 5 or 10-year period, they almost invariably underperform the market or underperform a simple index fund, as an example, the S&P 500. So stock picking really doesn't work. Track record investing really doesn't work. And the third myth we talked about is a thing called market timing. And market timing is when investors will try and guess when the market's going to go up, when it's going to go down. They take their assets and they pull it from the market, put it in cash, or a very conservative investment, CDs, which get next to no return. And then they try and guess when the market's going to go up and they get back into stocks. So they jump back and forth between stocks and equities and cash and bonds, etc. They move around. Now, it used to be that investors would really just move between cash type investments and equity type investments. But now it's even more dangerous because there's different categories in the market that brokers are trying to direct people to: small companies, international companies, value companies, emerging markets, commodities like oil, gas, gold, etc. So there's more and more categories that the professionals are trying to guess where this is going to go. The fact of the matter is, if you miss just the top 5-10 days in the market over a significant period of time, you're going to have a very negative impact on your return. It destroys returns. Stock picking, track record investing, market timing, those 3 things combined to destroy the return for the investor. The thing to do, just remember that investing in the stock market, equities, is a long-term process, and if you go into it with a long-term focus with the right allocation of assets, you're going to be a successful investor. Until next time, enjoy the springtime. And this is Paul Drinkon with Prosperity Coaching Associates.